Because digital goods have different properties than physical goods, the optimal organizational structure for decentralized finance protocols is likely going to differ from that of traditional finance. The fact that so many DeFi applications still inherit the same mechanisms, structure, and character of their legacy counterparts reflects the nascence of this industry. Arguably, Liquity better respects the architecture of Ethereum than other stablecoins by introducing algorithmic governance and having autonomous management of the protocol's assets. These features make Liquity relatively capital efficient, secure, and accessible compared to other over-collateralized borrowing protocols, potentially making it a stable building block for DeFi. Currency and debt are two foundational economic technologies that heavily influence the financial, social, and political systems that are built on top of them. Currency facilitates transaction, and its companion, debt, expands the domain of transactions. If these two institutions break or become corrupt, we lose a degree of economic freedom. This means that the strength of today's stablecoins, borrowing protocols, and other early infrastructure will determine the strength of coming DeFi applications, and it will heavily influence the future. Users access Liquity protocol from a decentralized front-end operator that facilitates traffic to and from the protocol. Liquity is an over-collateralized borrowing protocol application that issues its native stablecoin LUSD in exchange for ETH. Liquity fosters a different approach to borrowing by eliminating interest rates, facilitating instant liquidation, and designating community members as guarantors of last resort. A trove is a structure that holds the borrower's collateral and remembers the debt that was issued against it. The ether in a trove must be worth at least 110% the value of its debt, or the position will be liquidated. When a liquidation does occur, the Stability Protocol takes the trove's collateral and closes its debt position, leaving the user with the LUSD they borrowed. Anyone with some ether and an internet connection can access the Liquity protocol to take out an interest-free loan. Because Liquity is algorithmically governed, maintenance costs are not an issue. This means that the protocol doesn't have an imperative to charge interest to recoup administrative costs. Liquity employs a different business model that focuses on one-off borrowing and redemption fees. Fees are adjusted autonomously according to the redemption of LUSD, and they decay over time, oscillating between 0.5% and 5% of the LUSD borrowed. This borrowing mechanism can be used recursively to build a leveraged position for Ethereum. Notably, this corresponds with an increased risk, but tools like DeFi Saver allow users to calibrate the risk they assume. LUSD is an over-collateralized stablecoin with an efficient mechanism for price stability. It can be thought of as a smart stablecoin because the protocol effectively manages itself algorithmically. For a stablecoin to keep a constant price of $1, supply and demand must be accordingly balanced. Liquity restores the LUSD price by influencing demand through its soft peg mechanisms, in conjunction with adjusting supply through its hard peg mechanisms. Together, these mechanisms work to maintain a soft peg as close to $1 as possible, and a hard peg between $1 and $1.10. Liquity's floor hard peg mechanism keeps LUSD price above $1 in a clever way. Because LUSD is always redeemable for $1 of ether, when the price drops below the threshold, users can purchase LUSD at a bargain and redeem it for $1, pocketing the difference. And this creates a speedy arbitrage loop for rebalancing prices. In addition to rebalancing the price of LUSD, this process also reduces the amount of LUSD that's at risk of liquidation. LUSD is exchanged for ETH in the riskiest or most under-collateralized troves first. Debt is therefore paid down in troves with the highest risk of liquidation. This process can continuously occur until the system regains balance. Liquity has another hard peg mechanism at $1.10. When the price of LUSD goes past this, a user can make an arbitrage trade between borrowing and selling the maximum amount. For example, if the LUSD price increases to $1.11, you can lock up $110 worth of ether, take out a loan of $100 USD, and sell it for $111 USD. No matter if your loan gets liquidated or not, you have made an arbitrage gain of $1. Consequently, this action increases the amount of LUSD in circulation and decreases its price. Well, the hard peg mechanisms put a price floor at $1 and a ceiling at $1.10. Liquity's soft peg mechanisms keep its price as close to $1 as possible. The soft peg mechanisms work implicitly by adjusting the favorability of borrowing, which influences the issuance of new LUSD tokens in circulation. As the price of LUSD goes above $1, more people borrow as they assume they can repay the loan closer to the price of $1. Consequently, this will increase the amount of LUSD in circulation and drive the price back down. The stability pool. So the stability pool is a fund that backs the debt position in troves. It is composed of LUSD from stability providers, which is burned anytime a liquidation occurs. Users can become stability providers by depositing LUSD in this pool and receiving a proportional share of the liquidation. This revenue is simply the difference between the debt and the collateral for each liquidated trove. And because the liquidation rate is 110%, stability providers can expect to receive between 9 and 9.5% of the liquidated collateral. To ensure the protocol always has sufficient collateral, Liquity requires the average of all troves to maintain at least a 150% collateralization ratio. So this effectively puts a stability constraint on the distribution of debt amongst troves in the system. Now, recovery mode is an important factor of Liquity as well. So when Liquity's protocol has a total collateralization ratio that's below this figure, the protocol switches into recovery mode. And any position below a collateralization ratio of 150% accepts liquidation risk. The protocol will then liquidate positions in batches from least to most collateralized in all troves. Average debt to collateral ratio reaches 150%. When mass liquidations occur and the stability pool has exhausted its LUSD, the system switches into redistribution mode. Here, borrowers with higher collateral ratios temporarily back those with lower collateral ratios. Troves liquidated during redistribution have their debt and collateral proportionally spread out among the relatively more secure, over-collateralized borrowers. Each time a user sells LUSD for less than $1, they essentially pay another user to restore the peg. Okay? On the other hand, if someone should purchase LUSD above $1, they've accepted to pay a premium for it. Therefore, it's possible that over time, users will become conditioned to respect the peg. The main risk I see in the system here is that a flash crash could trigger massive liquidations and therefore cause the system to become temporarily under-collateralized. Historically, price moves like this are quickly corrected, so the system may only remain under-collateralized temporarily. And while this situation is unlikely, it should not be dismissed. In trying times, Liquity must rely on its efficient liquidation mechanisms and redistribution to keep the system balanced. Unlike UST, Liquity cannot just print more ETH to defend the peg. There is an inherent balance in the system that is quite elegant. LQTY is the asset, and it's a token created by the Liquity team designed to capture fee revenue from Liquity. So it has a maximum supply of 100 million tokens, which is being distributed to stability providers at a decaying rate. The token has two main purposes. Firstly, Liquity can be staked for a pro rata share of fee revenue from liquidators. Secondly, Liquity serves as an early adoption incentive for stability providers to deposit their LUSD in the stability pool. This simple token design differentiates the value of the token from the value of the protocol, giving investors a precise value proposition. The value of LQTY is a function of demand for the protocol's fee revenue, and so the more the protocol is used, the more users may want a piece of the fee revenue, and therefore purchase LQTY. Well, the bearish turn of events has caused significant sell pressure on the LQTY token. LUSD is holding up quite well, Ultimately, the value of LQTY can be expected to follow the protocol's activity loosely. Anyone interested at the profitability of being a stability provider or LQTY staker can look at the Dune dashboard that was linked in the original Medium article.